Hello, Assalamu alaikum. How are you, students? So today we have to continue June 2020, paper 21. We were doing 7707 O-level accounts. Uh, and I'm going to share your paper. So this is your paper. And we have done, I think, 3 questions. Huh? And today we have to start with question number 4. Now in question number 4, Rani, actually this is a question of inventory valuation. Okay. Now, Rani is a trader. Her financial year ends on 31st March. She provided the following information about her 3 types of inventory at 31st March 2020. Inventory item ABC, number of units, cost per unit, selling price per unit, and selling expenses per unit. What they are expected us to make total value of Rani's inventory. So what we have to do, we have to make a table. Okay. Now, see the table. I'm making the table. Item, first heading. Cost. Okay. Cost per unit. Then NRV. Net realizable value. Okay. Then lower of cost or NRV. Okay. So then number of units. Okay. Then amount. Now, see. Items, we have item number A. Cost per unit is $70. $70. Okay. NRV. So if we calculate NRV for A, it's $20 minus $2, which is the selling expense. So how much we can realize after selling item A? $18 per unit. So according to the concept of lower of cost of NRV, we have to keep, because NRV is higher, cost is lower, so we are going to keep this inventory at $70. $70. Okay, number of units we have for item A 110. So the total value of inventory 17 multiplied by 110, and answer is 1870. Okay, 1870 dollars. Done. Come to item B. Cost is $18. Come to NRV. Selling price is $19 minus 1 rupee selling expense. So NRV is 18. Now again NRV is same to cost. So we have no option left but to keep this inventory because the both are same. So we'll keep it on $18. Number of units 85. So 18 multiplied by 85, 1,530. 1,530. Come to item C. We have cost 15. Okay, come to NRV. Selling price is 16 minus 2. $16 minus 2, the selling expenses, and the NRV is 40. Now NRV is lower than cost. So we have to keep it this inventory on $40. I'm sorry. Then number of units we have 90. So if you multiply $14 by 90, we get the amount 1,260. Total amount of inventory would be 1870 plus 1530 plus 1260. Answer is 4,660. Getting my point clear? $4,660 is your amount. $4,660. Done. We got 4 marks. Now, other part. Rani later discovered that she had an amount of inventory of item D at 31st March 2020. This inventory originally cost $1,660. She considered this inventory to be obsolete. Obsolete means out of date now. Means Rani cannot earn a single penny on this inventory. So NRV is 0. Whatever the cost is, 1660, NRV is 0. It means now we have to tell Rani that she has to keep the cost of this inventory at 0 because NRV is 0. Are you getting my point clear? And if this item with 0 NRV is included, we cannot include it, we have to exclude. We have not included in the amount of closing inventory. So when an item is not included in the amount of total closing inventory because of 0 NRV, it's not going to affect the profit. Got it? Now, advise Rani whether or not she should stop purchasing item D to avoid having obsolete inventory in future. Justify your answer by providing advantages and disadvantages. Now, if she knows item D is a slow item and gets obsolete, expired, out of date in the stock, so she should not keep them because she will suffer loss every time if she fails to sell D item on time and it becomes obsolete in her storage. She has to bear storage cost also. She can save her money. She can concentrate on ABC. On the other hand, all those people who want to buy item D, if they won't find item D with Rani, they will go to somewhere else to find the item D and they will buy ABC from that place also. She will lose customers. Now you have to give the answer. Okay? What do you think is the best? Now, Rani earns advertising income by placing advertising boards in her shop window. The following details relate to her advertising income. On 1st April 2019, Rani had received $420 in advance and $300 was owed to her. Now, what she has asked, what question says, what we have to do, we have to make a T account of income statement. So first item, 2019. Okay, 2019. Here we'll put 2019. Done? Okay. Now date April 1. Okay. Balance. Balance BD. Advertising income. Balance BD. Due. If income is due, is receivable, it is on the debit side. It's an asset account. If income is received in advance, it is your prepaid income or it is a liability. So balance BD would be here $420 as received in advance. Okay. During the year 31st March 2020, okay, Rani received checks payment total 6,000. She decided to write off the amount 300. These are two transactions. Now see, 2020, 2020, March 31st, bank, how much amount? 6,000. She received 6,000. And on the same date, she decided to write off this 300. So we will put it in bad debts or irrecoverable debts. Done. And we'll put 300 here. Done. Then on March 1st, Rani had received 500 in advance. Advance income is your liability. So the balance CD of liability will appear on this side. March 31st. Balance CD would be the advances 500 and this will be your balance BD. Balance BD done 500 as a liability. Received income, received advance liability. So what about the other CD? The other CD is 400. So this is going to be reported over here. Balance CD 400. Done. And this will appear over here as balance BD. Balance BD as 400 receivable. This is 500 prepaid. BD come on this side and this side and the CD on the opposite sides. Now what is left? On 31st March, how much was transferred to income or what is the income from rent advertising? What is the income from advertising during this year? So we have to shift it to income statement. This amount is missing and we have to calculate this amount using our calculators. Now see what we have to do. Take the total of debit. This is 420 plus 6,000 plus 300 plus 400. The total is 7120. 7,120. Now deduct the two items on debit side, 300 and 500. The total amount, total income for the year is $6,320. Done? And we have earned 7 marks. Explain to Rani the effect on gross profit of recording sales of inventory as advertising income. Now, okay. Now here, the thing is, selling of inventory is the type of business operation, and we calculate gross profit by selling inventory. Advertising income is going to be added in gross profit as another income. And if we are recording sale of inventory and advertising income, it means the amount of gross profit is understated. Getting my point clear? Then, next question. Number 5. NPT Limited prepares its financial statements to 30th April each year. The company's retained earnings on 1st May 2019 was $14,000. General reserves were $35,000. During the year ended 30th April 2020, the following took place. The company made a profit for the year $28,000 after charging debenture interest. Okay. Now it means this is earning after interest. We need 28,000 is our profit, but this is not profit from operations. This is total earnings after interest on debenture. Transfer of 5,000 was made to general reserve. A dividend of $4,500 was paid. No dividends are payable for the year. Okay. Now, first we have to calculate retained earnings on 30th April 2020. So what we have to do? First step, retained earnings at start. How much? That is $14,000. This is $14,000. Done. Next item. What we have to add over here? Profit for the year. Profit for the year is 28,000. Earning after interest on deposit, 28,000. Done. Total. Now the retained earnings as 14,000 plus 28,000, total 42,000. Done. Total 42,000. Now we have to deduct general reserve for this year, 5,000. And dividend 4,500. Dividend 4,500. Total deductions from retained earnings is 9,500. Okay. Deduction should be in small bracket, so we remember that we have to deduct it. Now see, 42,000 minus 9,500. The answer is 32,500. Retained earnings at end. Retained earnings at or 30th April 2020. We have earned 3 marks. Okay. Now we have to make statement of financial position for MPT Limited on 30th April 2020. Okay. Now when we are making balance sheet, we have to be very much careful about the data. Okay. Now first, in a balance sheet, what we report non-current assets. Our first heading. And now see, what are the non-current assets we have? Fixtures and equipment at book values. Motor vehicles at book values. So fixture and equipment, fixtures and equipment, okay, at book values. So we'll report over here. And the second was what to say the second item? Motor vehicles at book value. Motor vehicles at book value. So fixture and fitting at book value is $152,000. Motor vehicles at book value 60,400. Total non-current assets $212,400. 212,400 is your total non-current assets. Total non-current assets, TNCA. Okay. Now, current assets heading. Current assets we have inventory. Inventory. How much is the amount of inventory? 30,000. 30,330. Done. Okay. Inventory. Okay. Now trade receivables along with provision for doubtful debts is given. So what we have to do? What we have to do? We'll write trade receivable. Trade receivable. Oh, in first column, that was 31,500 less provision for doubtful debts. How much? 630. We should keep it in bracket. Okay. Then net trade receivable would be reported over here, which would be how much? 31,500 minus 630, 30,870. 30,870. Okay. Any other asset? Current asset? No inventory. No. No other. This is how much? 30,870 and we'll get the total current asset over here. That is 61,200. and we'll get the totals over here. Total current asset, and now this is our total assets. How much? 61,200 plus 212,400, 273,600. Total assets 273,600. Done? Okay. Balance sheet is based on accounting equation. Assets is equal to liabilities plus capital. So what we have to do now, we have to report. So this is the one side of the balance sheet, total assets. And if we add liabilities and capital, we will get the same balance 273,600. This is the requirement. Okay. Now our heading, current liabilities. Current liabilities. Current liabilities, we have two current liabilities available. One is trade payables. Trade payables. Trade payables, how much? Trade payable is 24,900. 24,900. And bank overdraft, bank OD. Bank overdraft is how much? 6,200. Done? Okay. Now, long-term liabilities or non-current liabilities, whatever you write. Long-term liabilities, we have I'm sorry, 5% debentures payable, 20,000. Done. Now what we do, we will get total liabilities over here, TL. This is our total liabilities. How much? 30, almost 30, 40, 50, 50, 51,100, I think. 24,900 plus 6,200 plus 20,000. 51,100 is 51,100 total liabilities. Now, what we need? We need equities or finance by or capital. For capital, we use the word finance by. Okay. Now see, share capital. My opinion, if this is because this is a company accounting, so what we have to do, instead of writing finance by, we will write shareholders equity. Shareholders okay. Shareholders equity, share capital is given. How much? 1,50,000. Share capital, retained earnings, retained earnings. How much? Balance from the retained earnings account. What we have made statement of retained earnings, and the balance was 32,500. I think 32,500. And general reserves 35,000 old, 5,000 new. So total general reserves 40,000. Done. So if we get the total of shareholders equity, there are only three items. Total of shareholders equity 1,50,000 plus 32,500 plus 40,000. The answer is 222,500. Answer is 222,500 total shareholders equity. And if we add liabilities plus equity, we will get here same amount we should have. So 222,500 plus 51,100. Answer is 273,600. Yes, it's equal. 273,600 total equities. What we write here? Total equities. Done? It's balanced. We have earned 7 marks. Okay. The directors of MPT Limited are considering using the general reserves to repay the bank overdraft. General reserves is just a calculation or setting aside part of profit. It is not setting aside part of cash. So general reserve, because mostly income which we earn in company is not necessary. This is the profit is not based on cash. It is based on accrual income also. So it's not. So we are just setting aside the amount. We do not have that much cash available for setting aside general reserve. Okay. Calculate the return on capital employed for the year ended 30th April 2020. The calculation should be correct to 2 decimal places and should be based on closing capital employed. Now, capital employed, first we need return. This is the formula: return divided by capital employed. Okay. Multiply by 100. This is the formula of ROC. Okay. Done. Achha. When we are calculating return from the basic, it means it's not mean the profit after interest. It means profit before interest. Getting my point here. So what we have to do, we have to go more back to question, and we will find how much interest. Debentures 20,000 multiplied by 5%. Debenture interest is 1,000. So our profit is 28,000 after interest, and our profit will be 29,000 profit from operation. If we include interest again, so our return is 29,000 done divided by capital employed. Capital employed is very easy to calculate. Come here. What is the amount of total shareholders equity? You will say, sir, 222,500. Done. What is the amount of long-term liability? 20,000. And you will get capital employed. Long-term liabilities and shareholders equity. Done. Okay. Now when we calculate like this is 242,500. Very easy. This is 242,500. Multiply by 100 and you have to answer. You have to answer up to 2 correct decimal places. So 29,000 divided by 242,500 multiply by 100, 11.95. 11.95%. This is the answer. Easy. Now come to the directors are considering increasing dividend 2020 as a way of increasing return on capital employed. Advise the director how the return on capital employed can be increased. Justify your answer by commenting on both profit and capital employed. Now, have you missed something? This is the last part. Okay. Now see. If we see, let's Return on capital employed is 29,000. Return means profit. If you want to improve profit, first of all, you have to increase your selling activities. Simple. Okay. Increase your income. Anyhow, increase your revenues. Increase your revenues, decrease your costs, increase your profits. Simple. Increase your sales, try to decrease your costs, you get gross profit. Try to control your expenses, you will get better profit. Okay. Now, here $1,000 profit you have to pay for the debentures, interest. Getting my point? So obtaining finance through debentures means you have to pay interest as well. That will reduce your profits. Capital employed. See, capital employed includes long-term liabilities and your shareholders' equity. Okay. So anyhow, if we reduce non-current liabilities, our capital employed will be reduced. If we uh, if we do not take loans through debentures, we will be in a better position, both on the part of return and both on the part of capital employed. Okay, this is all theoretical matters, and this is the way you have to answer. Okay, now this is the end of the paper. Thank you. You are all welcome. For any type of suggestions, you are most welcome, all my beloved students. All those who are taking advantage of using my videos in learning accounts in O levels or A levels or AS or A2, you all are my students and my beloved students. Best of luck for you. I'll keep on helping you. If you want any further text of accounts or anything, you can contact me. Thank you. Take good care of yourself. Allah Hafiz.